So you see the headlines, right? Oil prices are everywhere. And every single time you look, it feels like they're just ticking up and up. And for most of us, the gut reaction is pretty simple. Okay, time to buy some big oil stocks. But then the frustration sets in. You see oil spike to over $100 a barrel, and you look at your energy stock and it's just flat. If that sounds painfully familiar, well, you're in the right place. We're about to break down a totally different way of looking at the entire energy market. This quote right here, it gets straight to the heart of the whole problem. It's an incredibly common trap to just bet on where you think the price of something is going to go. But what if the real opportunity, the smarter, more stable play, isn't in the oil itself, but in the essential systems that are required to get it from point A to point B? All right, let's really dive into this. First things first, let's dissect why that common approach, just buying oil stocks when you see scary headlines, can feel like you're constantly on the losing side of the trade. It's because when we react to the news, we're walking right into something we can call the headline trap. Look, the price of oil isn't just about simple supply and demand. It's way, way more chaotic than that. It's driven by these incredibly complex, totally unpredictable events. We're talking geopolitical flare-ups, drone strikes on key facilities, ships getting stuck sideways in a canal. These are what you'd call black swan events. They cause these massive, violent price spikes that are fundamentally impossible to see coming. Trying to trade based on that stuff isn't really investing. It's a lot closer to pure gambling. And this crazy volatility, it plays directly into our own human psychology. There's this super powerful bias called regret aversion. You know that feeling, right? It's that nagging fear of missing out, that little voice in your head that pushes you to buy high, right when prices are soaring, and it's all over the news. And it's the exact same force that makes us panic and sell low the moment the headlines flip, like when you hear whispers of a 2-week ceasefire. We end up buying at the peak of the hype and selling at the peak of the fear, which, as you know, is the exact opposite of a winning strategy. And here's the really brutal part, the thing that trips up even the pros. Right at the very top of a commodity cycle, when oil prices are at their absolute peak, the big oil producers are making astronomical profits. And that makes their stocks look deceptively cheap. You'll see a price-to-earnings ratio in the single digits and think, wow, I found a bargain. But this is a classic value trap. It seduces investors right at the peak, often just moments before that cycle inevitably turns, the price collapses, and it takes all those earnings and the stock price down with it. So if chasing the price of oil is basically a trap, what's the alternative? Well, we have to fundamentally shift our focus. Instead of looking at the commodity itself, we need to look at the infrastructure. It's time to bet on the bottleneck. Think about it like this. Back in the gold rush days, you had a choice. You could gamble everything trying to be the one lucky prospector who strikes it rich. Or you could be the person selling the picks, the shovels, and the blue jeans to every single prospector, whether they found an ounce of gold or not. So, in our modern energy economy, what are the picks and shovels? The real, enduring bottleneck is the infrastructure. It's the pipelines, the storage tanks, the LNG terminals, the power grids. Think about it. No matter who is producing the energy and no matter what its price is on any given day, that energy has to be transported from where it's pulled out of the ground to where we actually use it. That transportation system is the critical, non-negotiable choke point for the entire global economy. This slide lays out the two approaches perfectly, side by side. On the left, you've got your upstream companies. Think the big oil majors. Their business is all about getting oil and gas out of the ground. Their profits are completely changed to those wild, unpredictable price swings. But on the right, you have midstream companies. Their business is transportation and storage. They operate like a toll road for energy. They get paid a fee based on the volume of stuff that moves through their pipes. The key takeaway here is they're betting on the demand for energy to continue, not on its crazy volatile price. Okay, so this energy toll booth idea sounds great, but how does it actually work? How does it create such a stable business? Well, it all comes down to the way their contracts are written. They are specifically designed for one thing, predictability, and to protect against that downside risk. The secret sauce, really the bedrock of this whole business model, is something called a take-or-pay contract. Basically, this is a long-term deal, often for a decade or even more, where a customer, like a big power utility, reserves a certain amount of space in a pipeline. And here's the kicker. Even if that utility doesn't actually need to use all the space they reserved in a given month, they still have to pay for it. This creates an incredibly stable, predictable, almost bond-like stream of cash for the pipeline owner. This airline analogy just makes the whole concept click. So, an airline's biggest, most unpredictable cost is jet fuel, right? To run a stable business, they have to hedge that risk. So, they make a deal with an oil producer to lock in a price, let's say $70 a barrel for the next year. Now, the airline has cost certainty. The producer has a guaranteed sale. And who's sitting right in the middle connecting the two? The pipeline company. They get paid their transportation fee to move that oil, whether the actual market price that day is $50 or $150. They're totally insulated from the volatility that drives everyone else crazy. So we've got a business model that's built for stability. But there's another crucial layer here that makes these investments so compelling, and it all has to do with their unique corporate and tax structure. A lot of these midstream infrastructure companies are set up as master limited partnerships, or MLPs for short. Now, you can buy and sell their units on an exchange, just like a share of Apple or Microsoft, but under the hood, from a tax perspective, they work very differently, and it's a huge advantage for investors. Okay, so a normal company, a C Corp, faces what's known as double taxation. Think of it this way. First, the government taxes the company's profits. Then, when the company pays you a dividend from what's left, the government taxes you on that dividend. They get two bites at the apple. An MLP, though, is what's called a pass-through entity. It pays zero corporate income tax. The profits just pass through directly to the investors, who then pay tax on it at their own personal rate. What this means at the end of the day is that a whole layer of taxation gets eliminated, leaving way more cash available to be paid out to investors. Now, it's so important to understand this isn't just some old-school strategy for playing the oil markets. This whole bottleneck idea is becoming more critical than ever, and it's because of the gigantic technological shifts that are happening all around us right now. Let's just zoom out for a second here. This is so much bigger than just trying to protect your portfolio from the next oil shock. This is about positioning yourself for a world that is getting hungrier and hungrier for power every single day, driven by forces that are really only just getting started. I mean, this slide really just says it all. You've got Microsoft, one of the biggest, most sophisticated companies on the planet, actively looking into firing up its own nuclear power source just to feed its data centers. This is not a small problem you can solve with a few extra solar panels. This is a massive, systemic energy bottleneck that is forcing even the titans of tech to become, in essence, power companies. And to put a number on that, some of these new AI data centers are projected to need over 1 gigawatt of power. Now, what does a gigawatt even mean? That's the output of a small nuclear reactor. It is enough electricity to power roughly 750,000 homes. And that's just for one campus. The demand for reliable, immense amounts of power is just exploding. And here's the ultimate connection. The entire AI revolution. Every single time you use ChatGPT, every AI model being trained, every algorithm, it all runs on massive, constant, uninterrupted electricity. So investing in the energy infrastructure, the power grids, the natural gas pipelines feeding the power plants, that is the ultimate picks and shovels play for this new gold rush. You don't have to guess which AI company is going to win. You can just own the essential infrastructure that they all desperately need to even exist. All right, let's pull all of this together into one clear, actionable idea. What is the one thing you should walk away with from all this? If you remember just one thing, let it be this right here. Stop trying to guess the price of the commodity. Instead, focus on owning the indispensable infrastructure that gets paid on the volume that passes through it, day in and day out, like clockwork. The advantage of this whole strategy really comes down to these 4 points. You get stable, fee-based revenue from long-term deals. You have built-in protection from price swings because of that take-or-pay model. The MLP structure gives you huge tax advantages. And finally, it is a future-proof strategy. It's positioned to benefit from the relentless growth in energy demand, which is now getting supercharged by the AI revolution. And that combination can lead to a really powerful outcome for investors. I mean, right now, the average yield on these midstream companies is often more than 3 times the dividend yield of the entire S&P 500. And that leads us to our final thought. This way of thinking, of identifying and investing in bottlenecks, it doesn't just apply to energy. As our world gets more complex, these critical choke points just become more and more valuable. So the question I want to leave you with is this. Where else do you see them? Is it in the supply of fresh water, the bandwidth for data, or maybe the refining of critical minerals that we need for the green energy transition? That is the lens to start using as you look at the markets of the future.